Welcome back to Project Poles. In the last lesson, we started building CFEDs, which is the cash flow that ultimately supports our debt sizing and debt service profile. What we haven't implemented yet are levered taxes. And those matter because taxes will directly reduce CFEDs once we introduce interest, financing fees, and other debt-related tax effects. If you're new to this Deal Lab series, I recommend starting with part 1, where you can download the model start file for free and build the model alongside me. Link is in the video description below. Alright, now let's move back to the model checkpoint file from our previous lesson. In this lesson we will build the levered tax block, from EBITDA down to levered taxes, so the model can properly reflect the tax impact of financing. Think of this section as moving from operating performance to taxable income for equity, after considering the financing structure. We start with EBITDA, then subtract the items that are tax deductible, like depreciation and interest, to get to taxable income, and then apply the corporate tax rate. Alright, and first thing we will do again is pull in our EBITDA, which is reflected in row 497. So that equals to our EBITDA that we calculated in a previous lesson in row 399. So that's a simple linkage. Same goes for our depreciation expense. That is also again a simple linkage. Scroll up. And that is in row 448, already negative, so no need to flip the sign. Hit enter. And our earnings before interest and tax is simply the sum of those two. Hit enter and let's drag those over. Control R. That gives us an earnings before interest and tax of 149.8 million in case 8. And now let's move on to the actual interest expense right here. Once we introduce that, interest expense becomes tax deductible, which reduces taxable income, so taxes typically go down compared to the unlevered case. That's one of the key channels through which financing changes returns. And the first thing we will subtract is our senior debt interest. And since we haven't yet modeled any of our debt-related section, we will simply just set up the linkage without yet having any values. So that equals to, let's search for our senior debt interest in our debt section. And you can see down here that we have a term loan interest in row 571. And 572 reads interest excluding base rate sensitivity, and 573 is interest including base rate sensitivity. So we want to make sure that we pick up the interest including base rate sensitivity in row 573. And this here will be modeled positive, which is why we flip the sign. So this equals to minus K573. And let's anchor this to the row, F4 2 times, just in case. Hit enter. And then we also have a DSR LC interest, which is our debt service reserve letter of credit. And our DSR LC will actually be the last part of this financing section. But for now we can pull in that value as well. And that is going to be a hard code in row 664. That is going to be the total interest paid on the DSR LC after applying our copy and paste macro. So that equals to minus K664, hit F4 2 times and hit enter. Similar to senior debt interest, the idea for the DSR LC is simple. If the LC is assumed drawn, it behaves like a short-term financing instrument and creates interest expense, which flows then through taxable income. And even if it's undrawn, the commitment fees are still tax deductible, so they also reduce taxable income. So we want to make sure that we both pull in the interest expense and commitment fees under the DSR LC deduction. And then lastly, we will also subtract our non-cash amortization of deferred financing fees. And we have modeled this in our previous lesson up here, where we set up the account for non-cash amortization of deferred financing fees. And the amortization is reflected in row 468. And similar as row 462 and 475, this row will be negative. So let's make sure that we just pick it up without flipping the sign. Hit F4 2 times and let's hit enter. And then the sum of our earnings before interest and tax plus all the negative interest deductions will equal our earnings before tax or our taxable income. So let's drag this over, Control R. And just to reiterate on this line item right here, upfront fees on the financing are usually paid at financial close. But from an accounting and tax perspective, they're often treated as a non-cash amortization over the financing tenor. Essentially, solely for determining taxable income, we spread that cost across the debt life rather than expensing it all in year one. And now we cannot simply calculate our levered taxes based on the taxable income, because what we still have to consider, just like in the previous lesson, is our tax loss carry forward account. So for the levered taxes in row 504, we'll have a simple linkage to row 514, in which we'll consider our tax loss reversal. Hit enter and let's drag this over, Control R. So as you can see, again, in the early years, we have a negative taxable income. If taxable income goes negative, we don't get negative taxes, which would imply a tax reimbursement. Instead, we build a tax loss carry forward account. That loss can offset taxable income in later years, which delays taxes until the losses are used up. And for setting up the account, we follow the same logic as previously. The balance brought forward is the previous period balance carried forward. Then this is going to be the sum of those three rows here. And then for the new losses, which are in row 503, if it's negative, we want to make sure that we take minus, because if we have a loss, that's already a minus, and we want this to show up positive in the account. So let's flip the sign, minus the minimum of our earnings before tax, in case it's negative, and otherwise 0. Close parentheses. And why the minimum? Because here in this period, for instance, we have negative 8 million, which means negative 8 million is smaller than 0. So we'll return our 8 million value. And once it's positive, say in period 2032 with 11.4 million, then the minimum will be 0. So we want to make sure that we're not building up any tax loss carried forward if there's actually no negative taxable income. Hit enter. Let's drag all of these three guys over, Control R. And you see that we built up our tax loss carried forward account. And what's missing is our actual utilization in row 510. So for the utilization, we have an if statement again. If 503, our taxable income, is greater than 0, so we actually do have a positive taxable income, then in that case, we want a reversal of any tax losses that we have carried forward. So that is going to be a minus min. Again, our taxable income in 503. And comma, our second number will be our balance brought forward. So if there's any tax loss carried forward in this account, then we'll offset our taxable income against the account. Close parentheses, comma, and if this is not true, then we want a 0. Close parentheses, enter. Let's drag this over. Let's see if it worked. Control R. And you can see we offset our taxable income in year 2030, 2031, 2032, 2033, and partially in 2034. That then allows us to calculate our actual taxable income after tax loss reversal. And that is going to equal to, as previously in our unlevered lesson, max of 0. We want to make sure that our taxable income never turns negative, comma, and our earnings before tax in 503 plus our actual utilization in our tax loss carried forward account. So the utilization is negative. That's why we have a plus. Close parentheses, hit enter. Let's drag this over, Control R. And you can see that we start paying taxes in 2034 instead of 2030, where we would have a positive earnings before tax the very first time. And then we can calculate our actual levered taxes, since we now have a taxable income which reflects our tax losses carried forward. And that is going to equal to, taxes are a cash outflow, so we want to make sure they're modeled negative, minus our taxable income times our tax rate in G514. Hit F4 1, 2, 3 times. That tax rate can be found in the information memorandum as well in the inputs time independent sheet. Hit enter and drag this over, Control R. And now you can see that our levered taxes are negative 37 million. And these levered taxes also show up in row 504, which would leave us with a total net income of 112 million for now. And these figures actually align with our unlevered case. And that is definitely to be expected since we have not modeled any debt yet and we do not have any tax deductible interest expenses yet. So once we have modeled our interest in the following lessons, then we would also expect our levered taxes to go down further. And lastly, you can also see that now our CFETs are considering the tax effect, because before this lesson we have only subtracted our MMRA contribution, but now as you can see in 2034 we now also consider our tax effect, which reduces cash flow available to debt service in all taxable periods going forward. Great, we have now captured the full levered tax effect, which means our CFETs reflect financing reality. And in our next lesson we will move directly into debt sizing, using the CFETs and DSCR targets to determine the sustainable debt amount. Alright guys, this was it for this lesson, and I will see you in the next lesson. See you there.